and not to raise rates. And now we're here. And for political reasons, Wall Street might favor the fascist Dems. They're not democratic. They're not democratic. Democratic system believes in open debate, free speech. It believes in the right to defend yourself. It believes in having political opponents challenge and debate, not go to jail. It believes in defending borders and not permitting invasion. This is not a democratic party, so they've lost their name. They're the Dem fascists. They're very likely to get some support from the bankers to reduce interest rates and try to cause a little bit of a celebration with a bond market rally and a stock market rally and a feel-good chapter that will help the fascist Dems at the vote, at the election. So I think we're very likely to see a rate cut, and I'm not sure it's going to have any lasting effect. And I don't think it's going to have the desired effect. But let's leave that alone for now. I've talked about that before.
The Dow hit new all-time highs at the end of August. It's pulled back since then. What do you see ahead for stock markets as October approaches?
I think everything depends on whether they cut rates. If they cut rates 50 basis points, you'll see a stock market rally. And I will be happy about that for personal reasons, having to do with a payout that is due me regarding my father's death 4 years ago. It's been 4 years. He died at age 101. It's pulled back. Okay, fine. You know, what it does is it pulls back when they think, oh no, they're not going to cut rates. They're not going to cut rates. We're not going to get that boost that we're expecting. So they sell the stock market. But really, the stock market problems have been more tied to the Japanese financial crisis, which is something I've discussed at length in the last couple of shows. When they cut rates, they would like to see the dollar come down a little bit, but I think it's only going to come down for a trade advantage versus the Chinese currency. It's not going to go down versus the European currencies because they're in tatters. The European and British economy are in tatters. They're in terrible shape. So you can't have the dollar go down without the euro and the British pound going up, and they're not in a position to go up. What's happening now with respect to the dollar is an interest rate cut could hurt the dollar a little bit versus China and Japan. China is no longer buying treasury bonds with their trade surplus, which is quite substantial. They're buying gold. China is using their trade surplus to buy gold. They're dumping treasuries. We're in a situation, and I know it's coming up in a future question here, but nobody wants to finance our government debt, and they all want to dump our treasury bonds, and it's really a bad situation. Cutting rates is not going to fix that because the federal U.S. government debt is not fixable.
Does the U.S. dollar look like it's rising again following a significant pullback?
Well, as the crisis continues, the dollar will go up, and there are a lot of reasons for that. The dollar is considered almost like a knee-jerk international reaction. Financial crisis, let's get into the dollar. Let's get out of the smaller currencies, let's get into the dollar. Let's get out of the stock markets, whatever country you're in, and let's get into the treasury bonds. Okay, there is that knee-jerk reaction, but there's something far more difficult to describe that's going on. As foreign countries in the major Forex system sell treasury bonds, if they don't keep the funds in dollar reserves, their currency will go down. I've talked about this before. If a foreign major Forex country sells a lot of treasury bonds and goes into gold, for instance, their currency will go down, the dollar will go up. And we saw that in a gigantic way in Japan in the last several months. And that was not properly reported in the Wall Street Journal because they don't want people to understand the complex situation with respect to the dollar. When you liquidate bond derivatives, when you liquidate petrodollar derivatives, it brings about dollar demand. Dollar goes up in the crisis. I've been saying for 7 years, Jim, when we get to the climax of the government debt default and a global financial credit crisis, the dollar will go up, and then up some more and then vanish like a supernova.
Crude's been dropping in price. Why?
I think some of the major oil producers are in a little bit of financial trouble, and by increasing production, they lower the price a little bit and they increase their revenue. Russia has a small financial problem, and I believe they're, full tilt in production. And there's a lot of workarounds by way of India to supply gasoline. They call it the distillates. Gasoline, jet fuel, and diesel. India is supplying Russian energy to Europe. This is very interesting, very clever, but, there is some lack of unity among the OPEC nations. The OPEC nations are really gathering under the BRICS banner, and they're selling oil, and they're starting to sell oil in non-dollar terms. And it's affecting the dollar pricing. We're starting to see the Rockefellers lose some control over the oil pricing. But there's a lot of moving parts with this. The Saudis are, on and off and on and off. It depends on their projects. It depends on their relationship with Russia. There's a new term that started a couple of years ago, OPEC Plus. OPEC Plus Russia. Russia is now, I think, giving policy directives to Saudi Arabia and the Gulf region. That was never seen 10 years ago. Okay, there's a lot going on with the oil price, and I'm not very concerned about it, but there's another factor, and it might be political. It could be that the Rockefellers who controlled the Biden-Harris show, it could be that the Rockefellers have ordered a price decline in the oil sector in order to give a little bit of relief to the households and the economy so that they might not be so upset with the fascist Dems and therefore vote for Harris. But they'll have to overlook the 18 lies that she told yesterday. And I don't think the press is going to let her get away with it. So, and that's an important move to make a little bit cheaper the oil price, and gasoline prices will come down proportionately, or maybe even in an amplified manner. And notice that in the last year, they've not blown up any more diesel refineries like they did in 2021 and 2022. So what they're doing is they're raising the prices of energy, and now they're going to be lowering the prices of energy going into the election. This is very transparent, but there's a lot going on with the oil price. A lot of it is determined by the Saudis and the Russians.
We'll have more with Jim Willie right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
You're listening to goldradio.fm. Available online at HowStreet.com, TalkDigitalNetwork.com.
Welcome back. We're speaking with Jim Willie. Jim, gold's been trading in a range since mid-August. When it exits this trading range, do you think gold is going higher or lower short term?
Well, if they lower interest rates like 50 basis points, you're going to see the dollar drop a bit. Not a lot versus the European currencies because Europe is in a mess, but it's going to drop versus the Asian currencies, and that will bring about a gold rally. Now, I don't think it's going to be a substantial rally. I think silver might rally more than gold. There's something that's been happening for the last 5 weeks, and the epicenter has been Japan. If you remember, I think it was on the first Monday of August. I can't remember exactly, but I think it was the 5th. On the 5th of August, there was a big crisis out of Japan. And as a result of that, and we're 5 weeks into this, it was a temporary panic, and it got sort of resolved in the next couple of days. There were a lot of background events for that. And I talked about that last month, about the yen carry trade, borrowing Japanese money at 0% and investing in treasury bonds at 6% and earning tremendous, close to $1 billion. I'm sorry, earning $100 billion in interest per year just on that $15 trillion yen carry trade. Okay, this is a very, I'm sorry, I meant close to $1 trillion in profit. It's so many zeros that it can get confusing. But with $15 trillion earning 6%, you got about $900 billion in profit doing absolutely nothing at Wall Street. And it started to come apart. But here's what happened in that Japanese-centered crisis that Wall Street caused. We like to say that Japan was irresponsible. No, Japan was forced into 0%. Wall Street took advantage of it with the yen carry trade. And now the Japanese are trying to get out of the treasury bonds and into gold, and they've got themselves a problem because of the treasury bond paradox that I described. Here's what's been going on. Because of the expectation of a financial crisis, the arbitrage leveraged funds have been buying gold. Buy gold in the financial crisis. And because of the expectation of interest rate cuts and other distress that's being emphasized in the economy, like poor labor market and economic slipping toward recession, we're in a depression. Who are you kidding? Because of that, they've been thinking, well, the same hedge funds, the leveraged big hedge funds, they've been thinking, well, let's sell silver because it's a proxy for the economy. So pro-gold for crisis and sell silver for economic distress. It's an arbitrage trade. Buy gold, sell silver. And in the last couple of weeks, we've been seeing a little bit of a lift with silver and a little bit of a slide with gold because I believe that they're starting to come off that arbitrage trade. The reverse is you sell the gold and you buy back the silver. Now, if we get a rate cut, they're going to be getting rid of their arbitrage, buying silver, and going into gold because of the weaker dollar. And because of a lower interest rate, they're going to think, well, we have less risk of economic decline, so let's get back onto silver because that trade is now being pushed aside. So I think we might see silver go up and gold go up.
Focusing on silver, it's been pulling back since the mid-May top. Bullish or bearish on silver short term?
I think it'll go up because of reversing the arbitrage trade, and it'll go up because of interest rate cuts that will reduce the perceived risk of a economic decline.
Bitcoin's been putting in lower highs and lower lows for the past few months. Is this trend going to continue?
I don't really know. There are too many corrupt hands in this. I think Bitcoin and gold go up together. So if gold goes up, Bitcoin will go up. Donald Trump is speaking favorably about Bitcoin, advertising that he will work to make the United States a Bitcoin and crypto center, even using Bitcoin in part as a reserve currency, a cryptocurrency. So I think Bitcoin is going to go up. It's probably waiting for the interest rate cut also.
The BRICS Union meets next month in Kazar, Russia, where they'll launch the gold-backed unit. What do you expect the result to be?
Well, first of all, the unit was introduced in the June St. Petersburg Economic Forum, which has eclipsed Davos. Davos is a big banker barbecue where in late evenings they probably torture kids below ground. It's a banker barbecue. There's nothing economic about the World Economic Forum in Davos. There's nothing economic about Davos, period. The St. Petersburg meeting in June allowed BRICS to take over the agenda, and one of the biggest things that came out of it was the enhanced M-Bridge protocol that called for faster, cheaper, and no government interference on trade payments. And the device that the M-Bridge will have protocol coverage for is called the unit. And the unit is 40% gold and 30% each of the two currencies for the countries involved. So, country A and country B, well, they use their own currencies for A and B unless they decide to use something else. The unit was introduced in a big way in June, and there is talk and expectation that in Kazar, Russia, which is in the southwest part of Russia, a very large country, 13 time zones for the imbeciles in United States and Canada who don't know where Russia is on the map, 13 time zones. There's a lot of talk that in Khazar Russia, they're going to launch the unit, which is 40% gold. So over the last several months, several dozen nations have been dumping treasury bonds and buying gold. And I believe at the BRICS conference, you're going to see another big push in the gold price because it's going to let the world know the plans for using gold as the backing, as the basis for the unit. And the unit, I think it needs a better name, but they're calling it the unit now. It could be called the BRICS unit, might be called B unit later. I don't know. I don't really care. But they're talking about the launch, and that means usage, actual usage. And that means all these countries that have been dumping treasures and buying gold, they now have the gold reserves in order to use the unit. They can accumulate unit and use it in trade payment. They're not using the dollar. The overriding theme of the BRICS nations is not to use the dollar. Well, where? Well, not to use the dollar in trade payment. Don't accept trade payment in the form of treasury bills. Don't store the reserves surplus. Don't store it in treasury bonds. So you don't use it for savings and you don't use it for payment and you get rid of it in exchange for gold. This is a devastating new trend by the BRICS Union, which has achieved critical mass on a global scale. I was saying 4 or 5 years ago, 6 years ago, when the Eurasian Trade Zone, which is the BRICS now, when the Eurasian Trade Zone achieves 65% critical mass, they will be able to dictate global policy. Now they've got 80 to 85% critical mass, and the United States, Canada, England, Australia, and New Zealand are outside looking in with an arrogant look with their 5 eyes of corruption and narco-trafficking. We're going to see something big come out of Khazar Russia, and it's going to be about gold being the center in the backing for trade payment, and how gold would be the backing for monetary systems, meaning currencies, and gold being the backing for banking systems. It's going to be interesting to watch the new development bank. They call it the NDB, another lousy name, but it's the BRICS Bank. It's going to be loaded with treasury bonds that are dumped and used as collateral for actual projects. For instance, we just might see an expansion in Argentina of a port facility. They might have a $3 billion plan. It could be 3 or 4 different countries involved, and they will draw upon loans from the new development bank where treasury bonds are used as storage and deposits. So Argentina will have a big, big project at a port, and it'll be financed by dead treasury bills, dead treasury bonds, bills short-term, bonds long-term. And all the trade will be going into the BRICS system, and all the trade payments will be done in gold-based unit, and all the reserves will be stored in gold so they have more reserves for the unit. And the dollar's getting phased out, and the treasury bond is phased out as it experiences a default. BRICS growth means U.S. government debt default. This is going to be one of the most interesting BRICS meetings in the last couple of years. We had one interesting in August in South Africa, and we had a better one in St. Pete in June. I'm going to be all over it.
Do you think countries like Canada and the UK that sold off all of their gold at bargain prices are really going to regret it with this new currency that's backed by gold coming on?
Yeah, they're going to regret it, and they're going to have new masters for their country. The new masters will own gold. And what Canada's challenge is to remove the Chinese and develop a healthier, more honest, and respected partner that has gold. And it might be the United States.
Is there actually gold in Fort Knox?
Who gives a shit, Jim? That's not where it's stored.
Okay. Where is it?
Fort Knox has nerve gas.
Oh.
Military nerve gas. What I care about is where is all the confiscated gold, and I believe it's in the Greenland military base. The U.S. government's confiscated gold. I'm not talking about Fort Knox's mere 8,500 tons of gold. That was rescued before Trump's stolen election. Probably around 2018 or 19, Trump recovered that. They call it the Fort Knox gold. And it's a small trove. They've got other much larger troves. So it could be that Canada will merge with the United States financially, maybe even politically, and you'll boot out your Chinese slave masters. And if you have any kind of luck, you'll get rid of Trudeau and Singh and Freeland. Push them out where they can reside in New Zealand.
The U.S. government debt continues upward without any controls. Describe the global battle with the multiple parties to define the new global financial structure and its golden foundation.
Well, I have hopes to make this an entire chapter of the newsletter. I introduced this point in the newsletter recently in August, and I got to say that this is a very big topic. And furthermore, we don't really get much press coverage because the United States does not want to even admit that they're going to be facing a default. The United States says, well, whatever problem we have, we'll print money and we'll cover it. Well, if we don't have sufficient buyers of the Treasury bond to securitize the deficit, let me back up a little bit. U.S. government has a big deficit over a monthly period. They securitize it and create a bond, a bunch of bonds. And then they try to sell the bonds in the bond market, but there are no buyers except our friends. And we lend them money so they can buy some. And the rest, we print money and we buy our own bonds. Okay, that is a travesty, and that's what's been going on. A travesty. We say, United States leaders say we can print money and cover our own bonds, cover our own deficits, securitize it with bonds and buy our own. It's not a crisis. Well, it's a crisis if it causes price inflation, and that's exactly what we've been doing. But it's been a very queer price inflation problem with an aggravated supply system since the lockdown. Now, we claim that we can make it all good. We can print our own. Well, we have to print our own while others are dumping. And it's been rather well documented now that in the last several months, $2 trillion worth of Treasury bonds have been dumped by foreigners, and the proceeds are being stored in secret in USD Tether crypto. Lots of lies backing that up. I don't want to get into that because I don't want to lose my point. So foreigners are dumping treasuries. We got record deficits that we securitize with bonds without any buyers amidst this dumping internationally. So we're going to get price inflation, and we're going to have a difficult time supplying our ports for the import supply. The import supply. Now, I got called down by a client who said, Jim, you said that they're not accepting treasury bonds at the Long Beach port. Well, I got news for you. There's plenty of activity there. I wrote him back and said, how are they paying for it? Because they're not taking treasury bills, my good man. How are they paying for it? And the answer is with gigantic shipments of supertankers of oil. The foreign shippers, the foreign suppliers to the United States are requiring gold or oil, one or the other. And there was a time when we had 20 different U.S. ports loading up supertankers, and my very sharp colleagues, I give them a lot of credit for helping me look smarter than I really am, they pointed out that our foreign shippers and suppliers were being paid in oil credits so that the import supply at Long Beach, in Houston, in Savannah, and Seattle, in Portland, and Philadelphia, and the Chesapeake, and Miami, they all continue in operation. Now it's going to get a little dicey because the United States sold a lot of its oil reserves to China. And that's why they call him China Joe Biden. Now, in the midst of all, I give you the background now. It's going to be a gigantic free-for-all conflict. U.S. government has $35 trillion worth of debt. It's growing at $1 trillion every 90 to 100 days. Wall Street has $15 trillion in treasury bonds from the yen carry trade, and they need to unwind that. The Bank of Japan has about $800 billion more of treasury bonds they want to get rid of. The Rothschilds apparently sold $3 trillion worth of treasury bonds early in August during that Japanese crisis and bought them back. So that's a threat central banks across the entire globe are loaded with, along with sovereign wealth funds, are loaded with treasury bonds, and they're moving toward gold reserve accumulation, and they're actually calling that a debit. They're calling it the gold revaluation account. Check the accounting. Ask a professional accountant to look at this. And the central banks are calling their newly acquired gold a debit to offset their gold in the reserve account, the asset side. And they're about to flip that over and declare a $5,000 gold price. When they flip it over, they will double the gold price. All right, so central banks are a big player in there. The BRICS nations have, I think, up to $6 trillion. I think they got rid of maybe $2 trillion. They got $6 trillion in treasury bonds. So they're going to be dumping them to buy the unit. They need more gold. These are all trillion-dollar entities in a battle. Now, I mentioned 3 or 4 months ago that we had $8 trillion worth of long-term bonds coming due, maturing. We had another $2 trillion of short-term treasuries coming due, maturing. And we had our own $2 to $3 trillion of new debt that had to be securitized. So we had to find buyers for $12 trillion, which is $1 trillion a month. I believe the Exchange Stabilization Fund is being tapped for $1 trillion a month. Rob Kirby thought it had 15 to 20 trillion in it. That's probably very accurate. And it was funded by a 25% tax on all OPEC oil sales for the last 50 years. So the Exchange Stabilization Fund is a big player. The Swiss National Bank, this is a very big story. They've got a four-sided arbitrage. They need to buy back their Swiss currency and sell the accumulated euros. They need to sell back a lot of the FANG stocks, U.S. stocks, Facebook, Apple, Netflix, and Google, because they accumulated $3 or $4 trillion worth of assets, and half of it probably is in U.S. stocks, the FANG stocks, and they shorted gold, so they're going to be buying back gold. So they're another multi-trillion-dollar player. The oil-producing nations of OPEC, they have annual almost $3 trillion in sales, and they're not going to be using the Treasury bill anymore. They're going to be using, I believe, the unit and XRP. UAE, United Arab Emirates, they've already announced they're going to be using the XRP on a growing basis. India has already announced they're going to be using XRP on a growing basis for oil sales, oil purchases, UAE sale, Indian purchase. And nobody wants the Indian rupee currency, so that's going to be a perfect setup for advancing and growing the XRP volume. All right, so OPEC's a big multi-trillion-dollar player. Back in the home front, in the United States, pension funds hold $37 trillion, and the majority of that is in, well, I shouldn't say it. The biggest component is Treasury bonds. They own a lot of property, a lot of commercial property, a lot of malls, and that's got to be hurting. They have not had sufficient income from their Treasury bond nut to pay pension payouts, retired people. Insurance companies in the United States own over $8 trillion, and 62% of that is in bonds, and they don't make enough income to do insurance awards, and they're trying to wiggle out of all the vaccine death awards. The narco funds are an interesting player because they have about 1 to 1.5 trillion in narcotic sales annually, and they have been now moving their dollars into the United States with the migrants, and they've been moving their dollars into gold, and they've been moving their dollars into Bitcoin. So they're a big trillion-dollar player. And then you have Big Pharma with the $4.5 trillion market cap. And then you have the military contractors with nearly $1 trillion market cap. And then you get the last one. I did not have this in the August report, but it got pointed out to me very quickly. The hedge funds, which are the big gambling centers attached at the hip with Wall Street banks for borrowing funds, they've been shorting Treasury bond futures and buying Treasuries, and now they got $1.1 trillion. Oops. So they need a rate cut. The big banks are holding 700-something billion in losses, unrealized losses. They need a rate cut. And my joke, and it's not really too funny, but the big banks are holding like $750 billion worth of unrealized bond losses. And with a little bit of a rate cut and a rally, it might only be $600 billion. Wow, that's not going to help much. And then the annual borrowing cost for the U.S. government debt is $1.2 trillion and growing. So with a rate cut and a bond rally, maybe it'll go all the way down to $1.0 trillion. Whoop-de-doo. Not going to mean a whole